Hi, my name is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And in my regular episodes on Wednesday, I obviously talk about the theories, methodologies and principles associated with investing. The aim of these case study episodes is to share how the application of that approach has worked out in real life for some of my clients. Now, before we get into it, one of the downsides to podcasting, from my opinion, is it's a very one-way conversation. You get to listen to me, but it's very difficult to ask questions to a podcast. I mean, there's a lot of Q&A podcasts, but in terms of questions on those episodes, whereas I think YouTube tends to sort of solve that problem. And I've really enjoyed being able to answer questions on YouTube. And so if you're interested, if you have a question for me, jump on YouTube. There's actually a specific video, I think, which we'll try and profile, which invites questions, but, put some comments on there. And it's great to receive feedback. So thanks for everyone that's been doing that. I've been on leave for a couple of weeks, but now I'm back and I've answered all those questions that occurred while I was away or that we received while I was away. So keep them coming, and I really enjoy that sort of two-way exchange, if you like. Now, today I wanted to talk about a client that I have known for more than a couple of decades. In fact, we started dealing with each other 20 years ago. In fact, one of the bits of feedback I've received on these case study episodes is that there's been a little bit of a common theme with a few of them where, the property assets haven't performed as expected. And in a lot of those case studies, the clients might have only owned the property for 10 or fewer years, or it could have been apartments. Apartments have really underperformed, particularly in Melbourne, over that period of time. And the comment was, well, it'd be great to hear about some successful property investment case studies. And so I hear you loud and clear. And I thought it sort of dawned on me that, yeah, that's true. I should share a really positive one. Anyway, so I started dealing with this client about 20 years ago. And 20 years ago, all we were doing at Pro Solution was mortgage broking. And so that's how we built the relationship. So it's been a long-term relationship. I think about 4 years ago, the client became a tax client. And a couple of years ago, maybe only 18 months ago, they became a financial planning client as well. So we haven't offered financial advice over that period of time, but certainly we've offered different services. Notwithstanding, I thought it was good to have a look at his investment property portfolio because he's held a lot of these properties for many years. And I think it's a good insight to, how it might work out if you want to invest in property, how it might work out in the long run. And then most importantly, I thought we could reflect on his portfolio. And, what I did is ask myself, what could I learn from how he has conducted himself and what has he done well and what has he done not so well? Okay, so let me give you the numbers. Let's start with the numbers in terms of portfolio and overview. So he's got 10 investment properties that are worth around about $23.5 million in total. The average holding period of these 10 properties is 25 years, but they range between 10 and 32 years. So some he's owned for 3 decades, some only held for 1 decade. He purchased these properties between 1989 and 2014, so spanning over a 25-year period. So for those people that really try and rush into the property market and try and buy 3 properties in 1 year, don't always need to do that. The weighted average capital growth rate across the whole portfolio is 6.8%, but the property's performance sort of ranges between 4.5% and 9.5%. So he's got some properties that have done really, really well and some that haven't done so well. In fact, that 4.5% property has a personal use element to it. So it's partly for a holiday house. So, that might explain to some degree why it hasn't performed as well. The gross rental yield currently across the whole portfolio is 2.6%, and the net rental yield net of expenses is therefore going to be around about 1.7%. So 6.8% growth, 1.7% income net of expenses gives you a return of 8.6%. Pretty good considering all you need is 7.2% and your wealth doubles every 10 years on average. So he's certainly exceeded that. 8 properties are in personal names, in joint names, in fact, with his wife. 1 property is a commercial use property that's owned in super. That was part of his business, where he operated his business from, still operates his business from. And 1 other property also inside super, an apartment in Bondi. So most in personal name, couple in super there. Okay, so what can we learn from the portfolio and the experience over the last couple of decades of working with this client? Well, I think the first thing, which I kind of always bang on about in my podcast, is that property can take time. hope when you invest in property that in 5 years from now, you would have started to accumulate a little bit of equity. 10 years from now, if you've done well, you've got hopefully a reasonable amount of equity. But really, the compounding capital growth really takes 2 or 3 decades. It does take time. And this client has stuck with it. He's not been distracted. In fact, he's very, very good at managing cash flow. He actually has no debt against the portfolio. But even if you had debt against the portfolio, he's accumulated $17.5 million of equity, so current value less cost. So even if he had some debt against, or all the debt against the property portfolio, he's still got a substantial amount of asset or net worth there. So it isn't because he's repaid the loan or that's been obviously helpful and contributed to it. It's really that he's just stuck with it, and he's bought property over a very long period of time and held it over even a longer period of time, knowing that it really does take that many, many decades to enjoy that compounding capital growth, which means the sooner you can start that investment journey, the better off you'll be. When you look down the property portfolio, the best performing assets tend to fall into 2 categories. Either they're really located in perfectly blue chip suburbs, so, close to the CBD in really good quality locations, and the ones that are further out, further away from the CBD have performed weaker than the others, or they have some sort of uniqueness with them, so that they've got water views, close to the water, those sorts of things. And as you know, I talk about in the normal Wednesday episodes, I talk about sort of an evidence-based approach towards investing, and I bang on about sort of blue chip investment grade property, that has those 3 attributes in terms of land value, some uniqueness or scarcity, and then that proven performance. These aren't things that I've dreamed up over the years. It's observation of actual portfolios, and this is a perfect example of such a portfolio. Also, if you look at the ones that have performed sort of poorly, they tend to have some sort of impairment. So if they are on a busier road, they've performed not as well. And we're looking at, again, average 25 years worth of data here in terms of holding periods. So we're looking over very long periods of time. And over that sort of 25-year period, really he's been investing since 1989, so even longer. Of course, he's seen higher interest rates, he's seen credit crunches, he's seen changes in governments, lots of different proposals, changes in council, all those sorts of things over that period of time, and still enjoyed those quality returns. One thing he could have done differently, all the properties are in the same state, and as you saw when I gave you the description of the portfolio, 8 out of the 10 properties are all in personal joint names. So I think, looking at his situation, he could certainly have done things a little bit differently. I would have said, well, certainly introduce some geographical diversification, so invest outside your domicile state, and then think about land tax and other taxes and flexibility. So therefore think about your ownership structure as well. Look, sometimes when you're making piecemeal decisions, so you go and, okay, what's my next step this year? I'm going to go and buy an investment property. And then, maybe 2 years elapses. What should I do next? Let's get another investment property. This one has some equity. It's okay to kind of make that piecemeal decisions, but one of the consequences of doing that is you don't really then have a longer term plan and you don't know where you're going to head to. Whereas if you start with the end in mind and you realize, okay, this is the goal, I want to have X amount of assets, I want to hold 3 investment properties, and ask ourselves, where do we want those properties to be held? And so at least he started thinking a little bit further afield in regards to that. And he does have one inside super when it was very popular to actually buy inside super. Notwithstanding, it was still a good decision. So being a little bit more strategic, a little bit more forward thinking, particularly around aspects around land tax, which I know have been in the news again this week with New South Wales making some changes. It's something to consider and something maybe he could have done differently if he was able to go back in time, which he's not, of course. Now, the final thought that I'll leave you with is that most of his properties have done well. As I said, the compound annual growth rate, so this is not including income, has ranged between 4.5% and 9.5%. So none of his properties have really been an outright dud. As I said, the 4.5% one has a personal use element to it. So if you exclude that, it's really between 6 and 9.5%. So again, they've all been pretty good, despite, them not all being perfect. The point that I've tried to make in the podcast a number of times is I don't think that performance will repeat itself. So putting it differently, I think the performance between a really good investment grade property and one with impairments over the next 30 years, the performance will be greatly different. So maybe the good one will give you 8% and the poor one will give you 3%. So that sort of disparity, if you like. And the reason for that is really mostly around borrowing capacity. Borrowing capacity has risen so much, so the broader market has risen so much over the last 30 years, whereas it will be really dependent on borrowing capacity and demand. So you want the demand, but then you want the demand from people that can afford to pay more. That's not always linked to borrowing capacity. It's also linked to wealth and sources of wealth beyond, borrowing from a bank. And so if we're going to target those really good quality, high quality blue chip areas, the thing is that a lot of people that want to live in those areas have alternate sources of wealth and income that grows at a much faster rate than the average income in Australia. So when we look back at his portfolio, you might draw a conclusion, well, it doesn't really matter where in Sydney you bought property, it's going to work if you hold it for 30 years. That could be true over the next 30 years, but I think it's less likely. I think it's unlikely, in fact, than what it was over the previous 30-year period. And so I've been trying to make this point that, hey, think about where in the cycle are you buying in terms of the market that you're buying into. If you've just bought after a growth spurt, say Adelaide, for example, has had a tremendous growth spurt, well, maybe your future returns are going to be less than attractive. Whereas if you're buying just after a very flat cycle, like, for example, Perth, well, then maybe you're at least positioning yourself to enjoy better than average returns. And then secondly, think really carefully about the quality. Now, I'm bleeding into my normal sort of episode on Wednesdays, further away from a case study episode, but I thought it was worth mentioning because when we look at, a really good portfolio that's performed really well, that's hit the mark, of course, it's good to think about, well, some learnings we can apply for the future and some we need to be really careful about. So anyway, I thought it was a really good case study because, as I said, he's acquired those assets over 25 years. So it's been a long journey from an investment perspective that he started a long time ago, and he started early in his life. He's not that old, and does show that, slow and steady wins the race. And if we are patient investors and we've made the right decision from the outset, we'll be rewarded. Anyway, until tomorrow, bye for now.